We're joined by Stephen King, Chief Global Economist at HSBC, and our Europe editor, David Tweed, is also here. Let's just talk about Slovakia. There we are, a country, smaller population than the size of London. Now, nobody sees this as a major problem for holding up the ratification of the ESFS, but it does hold a strong light into European decision-making, doesn't it, which is mostly part of the problem.
Well, there's partly a sort of pork barrel politics story, which, of course, is that getting individual countries to force through things may be difficult. Perhaps you need to have some encouragement from, say, Germany or France, maybe a few loans here and there, whatever might be the case. Actually, rather similar to what we see on a day-to-day basis in the US. This whole process of negotiation, continuously fraught, whole series of checks and balances make decision-making a lot more difficult. They compare the US with the UK can pass a budget instantaneously. The US spends months and months debating it. And in one sense, the Eurozone is a bit like the US. Debates continuously going on, no immediate answers.
Let's talk about the recapitalisation of the banks, because we are expecting José Manuel Barroso to come up with his plans for the European Commission today. Can I ask you, do you think using the ESFS as the way to recapitalise banks is the solution here?
Well, you need to have some support somewhere. I mean, the reality is that there are two immediate difficulties. The first one is the problems with sovereign bonds. The second is the issue with the recapitalisation of banks. Both of them have been identified as difficulties. But frankly, although they are short-term problems, there's a much bigger long-term problem out there, which is that there is a lack of political unity within the Eurozone. And even if you come up with these short-term solutions, there's uncertainties about what happens to the euro a year, 2, 3 years down the road will still continue. So the grand plan isn't just about the story about bank recapitalisation. It has to be about the political future of the euro.
So are you talking then about the need for closer fiscal governance? Jean-Claude Trichet has spoken about the need for putting into a place a finance ministry. Is it the institutional underpinnings of the euro which need to change here?
Well, the reality is when you look at the history of monetary unions, the ones that succeed have some kind of fiscal union, the ones that fail do not. So history is not really on the euro side currently, unless you make some significant changes. Of course, the problem for markets, they want changes now. You cannot possibly have a fiscal union of any kind in the near term. What you need instead, I think, is a timetable. You basically say, this is what we're going to aim for in, say, 2017, 2018. Here's the timetable. This is the commitment. This is the political process we're going to go through to get to that particular point in time. Then you've got a reasonable chance of giving the markets an indication that something will change, which is going to be useful long term. Without that, you've got continuous uncertainty.
Let me just interrupt just for a second, because we've got some breaking news coming into us and some comments coming into us from the Bank of England. We were saying that QE the success of QE will depend on the global economy, and we're getting that QE will depend on the world and global economy. Can I just get your take on that and where you think central banks are going as far as quantitative easing and the way they're running things globally at the moment?
Well, I think the Bank of England's view is very simple, that doing QE is better than not doing QE, although they can't really define precisely what the benefits of QE might actually be. But the reality is that when you go back to, say, 2008, 2009, there wasn't a single central bank on its own that could solve its country's problems in a global meltdown scenario. So in one sense, what the Bank of England is saying is, if problems persist in the Eurozone, if the Eurozone crisis gets worse, if Europe ends up going into recession over the course of the next 12 months, the UK is absolutely connected with that. That we may have a flexible exchange rate, we may have flexibility in interest rates, and so we can print money. But the reality is that our major trading partner is Europe. If Europe goes wrong, then the UK is also in trouble. So there are effectively limitations in what you can achieve through monetary policy.
I mean, it's interesting, Stephen. We had Alcoa coming out, the first results of the earnings season. They were saying that the European debt crisis, it is weighing on their results. I mean, how is that affecting emerging markets? Everybody's really being dragged down by all this.
Two things, really. The first is that we've had a peak in world trade much earlier in the year that's been slowing significantly. Manufacturers all over the world are being hit by that, which hasn't really been particularly helpful. The other thing in the emerging world is that there was a big problem with inflation. Late last year, early this year, we had a lot of policy tightening coming through, and that policy tightening seems to have hit the domestic economies as much as we've seen slowing coming through on the export front. Put the two things together, we have the weakest readings on our index, apart from the period during 2008, 2009, during the global meltdown. So apart from that particularly bad news, things today also don't look particularly good.
But, I mean, yesterday we saw the Bank of Indonesia cutting interest rates. The Philippines has just announced a very small fiscal stimulus plan. Would you expect to see an easing in monetary policy in Asia, and also maybe some fiscal boost coming from governments?
There's been a big shift, actually, over the last few weeks, really. There was a big focus earlier in the year on inflation. We're now getting a much bigger focus on growth that's coming through a number of Asian countries. It's not just confined to Asia. You look at Brazil, they cut rates recently. We're seeing a general trend towards saying the big problem is growth rather than inflation. It's a big shift. It's associated with this really significant slowing of global activity. Now, it's worth stressing that, take China, for example, it's still growing fairly nicely. Our forecast for next year is still growth of well over 8%, but that's still not particularly impressive compared to what we saw a year or 2 years ago.
Can I just ask you, actually, moving on to China, because obviously there's a big question in Europe on banks. China, I mean, these are banks which have really been splurging on real estate loans. Is there a big risk? Are you worried about potential problems for Chinese banks?
Well, I think there's one big difference, which is that in Europe, you have no growth. And with no growth, good loans can turn bad. It all makes life uncomfortable for banks. In China, although there may be some bad loans out there, in one sense, you can hide those bad loans by having continuously rapid growth. And the growth is not because of the splurging on loans. It's more to do with the fact you've got massive structural supply-side improvements coming through in China over a sort of multi-decade period. So as long as that continues, then things are okay. I mean, the sort of test case for this is Japan back in the 1980s, after many, many years of strong growth and probably poor capital allocation. By the end of the 80s, Japan bumped into a supply-side constraint. Once it did that, then the bad loans became a bigger problem. China, I think, is not so much a problem now.
Talking of growth, we've got anemic growth, for heaven's sake, in the United States, and we had that setback now for Obama with his job plan in the Senate last night. Just how much of a setback is that for America's recovery, do you think?
Well, I don't think anyone really thought that Obama's jobs plan would go through straight away. Again, the problem with the US is constant use checks and balances between the administration and Congress. Nothing goes through smoothly. There's constant sort of horse trading. Of course, we've got the presidential election coming up next year. So the ease with which Obama can get through policies which might work is actually rather reduced.
And even if he did, how much scope does he have to actually do anything?
Well, part of the problem is that the US is increasingly, I would say, looking like Japan's experience over the last 20 years. The good news about the US, we appear to have avoided the Great Depression Mark II, which have been truly catastrophic. The bad news is that we have a very, very anemic recovery. This is by far the weakest recovery that we've seen in the entire post-war period. And that's despite the fact you have massive policy stimulus. So the debt problems we see in Europe are also debt problems in the US, and that's really constraining growth.
And as long as you have that anemic recovery, you don't have any recovery in wages. So this is really the issue for the US going ahead.
Yeah, there's no significant income coming through. You've got high debts, no income, put two together, and you end up with a deleveraging nightmare, basically.